Hello there, welcome back to my channel. We are going to put it all together in this particular video. I talked about intra-group trading, and then we talked about current account balances. We talked about unrealized profits. We talked about transfer of non-current assets. We talked about loans and then interest on loans and dividend payments and how to trace them in the consolidated financial statements. So in this particular question, we are going to put it all together. This is a very standardized question, and so we are going to look at it and see how we can do the various adjustments both in the workings and then on the face of the consolidated financial statements. So thank you very much for sticking to my channel. I appreciate your time here. If this is your first time on my channel, please subscribe to the channel, and why not consider sharing the video with others so they can also benefit, and leave your comments in the comment section if you have any questions for me or suggestions. All right, so let's get back into business for today. So we are going to prepare the consolidated financial statements, and as usual we are going to have the format here. So a way to do the consolidation is to actually have a format in your head using the separate financial statements. So using the financial statements here, we can actually have a format of the consolidated financial statements. So always draw up the pro forma before you go to the workings. So we will have our non-current assets. For the non-current assets, we will have property, which you can actually shorten as PPE, and then when you are writing manually, you can bring your brackets, PPE, bring your brackets, and then you put your figures in there. Now this particular company has another element called investments. Now in my previous video, you could see that we replaced investments in the subsidiary. This one, the investment is general, and from the start of the question on May 1st 20x7 can do but 60% of shelter, paying 76,000 cash. This is the investment in the subsidiary, but we have 98,000 here, so we don't know what again is included in this 98,000. It might be an investment outside of the group, so that's why I've put my investment here. That is the first trick for you. So the first thing is actually read the question first. Then after that you can draw up your the pro forma consolidated financial statements. In this case, the consolidated statement of financial position. So we have our investments there. Then we know that we have to have a goodwill, and that is going to be our workings 3. All right, so that is it. Then we have our current assets, and then for our current assets we will have inventory. We'll put my bracket there. For receivables, I'll also write my receivables and put a bracket, and then lastly I'll have my cash, also put a bracket here. Then I'll come to equity. So let me bold in this. I'll have my equity and liabilities. For that, I will have equity, for the equity I have share capital. You have share capital there. We will also have retained earnings, and we know that our retained earnings is going to be coming from workings 5. Guess that's right. So retained earnings, and then we also know that non-controlling interests form part of our equity. So that is going to be our workings 4. So we have everything here set up nicely. Then we'll go to other elements, which is the non-current liabilities, and that it is only one, that is 8% loan notes, 8% loan notes, and then we also have our current liabilities, and that I'll put my brackets here, and then we move. So this is a quick pro forma of the consolidated financial statements that we want to look at here. Now when you look at it, I have put 3 formats here. Actually, these are for the parents, so I can put parent, and then I can also put my subsidiary here, and then the last one is the group. I want to also insert another column here and call it the adjustment. So let me just shorten it, adjustments. Alright, so let's quickly format these spaces so they can accommodate every form of calculations that we'll be doing here. This is Microsoft Excel. So when you are preparing your financial statements in a Microsoft Excel, this is how you have to do it to make life easy for yourself. So we have everything set up. Then we can also format the entire space here. Let's format the entire space as an accounting figure with 0 decimal places. Alright, so we have it there. The brackets, I've put the bracket here for those who might be writing or who are learning the manual method, who will be writing manually. So I'll be doing both manual method for the people who write exams manually on paper, and then for those who use any form of for example the ACCA, who might use the ACCA CBE platform for their exams. Alright, so we have everything set up. Then quickly we go to our workings. That is the second step in preparing your consolidated statements of financial position. So we go to our second step, and the first working, as we have previously seen, is the group structure. So what's the group structure here? Now we can read our question. So let's go to first. You have to read the question to prepare your pro forma consolidated financial statement, and then you go back, and then now you are going to make calculations. So you read the question again to determine your group structure and then what values you have to include in your calculations. So now we are going to read the question again, but this time with a careful look. So on 1st May 20x7, can do bought 60% of shelter, paying 76,000 cash. So quickly from that information we can derive our group structure. So I'll have can do here, and then I'll have shelter here, and then as I did before, I can use the draw tool to draw a line from can do to shelter like this. come back to my home, and this occurred by buying 65%. So I can write my 65% there, which has converted to 1 for me, but I don't want that. I want the percentage figure, so 65%. And so our NCI will be equal to the difference between 65% and 100%, and that is 35%. So our NCI is 35%, and this occurred on first. So let's go back and read that. This occurred on 1st May 20x7. So in order to save time, I'll leave a link to download the video, the question, in the video description, so you can follow along. All right. Is it 65%? 60%. So this is 60%, and the NCI will be 40%. All right. Now we have our acquisition. We have our acquisition date, and that is 1st May 20x7. And then what is our report? Is the date is in the requirements. Prepare the consolidated statement of financial position as at 30th November 20x7. So as you can see, I have not actually read the entire question yet. Consolidation, you are supposed to do this within 40 minutes maximum of 40 minutes. So you have to be very, very fast when you are doing this. So as and when you read an information, as soon as you know how to treat it, you go ahead and treat it before you go to the next, so that you don't have to read everything again and again. That will waste your time, because believe me, the additional information we have here is actually not much. A typical exam question has more information than this, but the principles are the same. All right, the principles are the same, but it has a volume of information that you will see. So you have to be very, very time conscious when you are dealing with consolidated financial statements preparation. All right, so we have the reporting date. You have the reporting date to be 30th November 20x7. So the post-acquisition period is going to be, what is 1st May? How many months are between 1st May and 30th November? So we have May, June, July, August, September, October, November. So that is 7 months. So we are saying that our post-acquisition period is 7 months. It's 7 months. Now, this is important. This is what we call mid-year acquisitions. I want to introduce some new things. That is the purpose for solving the question, so that I can explain in detail some other things that I haven't covered in the previous videos. So this is what we call a mid-year acquisition. And what this does is that whatever will have to affect our retained earnings would have to be adjusted for the period between the acquisition date and the reporting date. But items that are relating to the statement of financial position only are going to be treated as a whole. Why? Because the statement of financial position is prepared at a particular date, whilst the statement of profit or loss is prepared for the entire period. We are going to the statement of profit or loss consolidation, so we will get there, but I want to explain this because it's going to be relevant in our work in this video. So whenever there is a mid-year acquisition, we adjust all items that are coming from the statement of profit or loss. We adjust them for the period between the acquisition date and the reporting date only. So any amount that we are going to include in our consolidation will be the amount for 7 months only. That's what I'm talking about, for 7 months only. All right, so this is our group structure. Now the second working, which is workings 2, is our net assets schedule. Now for the net asset schedule, what we have here is we will have an amount column at the reporting date. At the reporting date, we will have an amount column for at acquisition date, and then we will have an amount column for post acquisition profit, or others call it post acquisition reserve or post acquisition movement. Whatever you see, the idea is the same. All right, so you can see post acquisition profit, post acquisition reserve, or post acquisition movement. It is talking about the same thing. Okay, so we have here, I don't want to expand it too much. All right, so the first, as I said in my previous video, the net assets is derived, the term net asset is derived from the basic accounting equation, which is assets equals equity plus liabilities. Now when we make equity the subject of that equation, it becomes equity is equal to assets minus liabilities. So asset minus liabilities will give you the equity. So when you talk about net assets, that is talking about the equity of the subsidiary. Now the net assets is referring to the subsidiary, so net assets of Shelter. If the subsidiaries are more than one, we will prepare net assets for each of them in the group. All right, now the first item from our question, the first item from our net assets is share capital, and then the second one is retained earnings. So we are going to put our items here. So I'll have my share capital, and then I'll also have my retained earnings. Now, what is the value at the reporting date? The value of the share capital at the reporting date can be found in the statement of financial position of the separate entities. So we know that the second values here are these values. So for my share capital is 40,000 for Shelter, and then the retained earnings is 69,000 for Shelter. So 40,000 and 69,000. As I said, I have left a link to download the question in the video description, so go download it and follow along. So we have at the reporting date is 40,000, and then for my retained earnings at the reporting date is 69. Now the net asset schedule, as I said, is used to treat every item that is relating to the net assets of the subsidiary. So everything that will affect either of these figures, and mostly we are talking about the retained earnings. Any item that will affect the retained earnings is going to be treated under the net asset schedule. All right, and this one we are talking about just items relating to the subsidiary. All right, now the first information here is that the inventory of can do includes 8,000 of goods purchased for cash from Shelter at cost plus 25%. Good. So we are saying that the inventory of can do includes 8,000 of goods purchased for cash from Shelter. In this case, Shelter has sold goods at cost plus 25% to can do, and an amount of 8,000 of these goods purchased is still in the inventory of can do, the parent. So as I said in my previous video, whenever the seller is the subsidiary, we adjust for the unrealized profit within the net asset schedule, because that unrealized profit is going to affect the retained earnings of the subsidiary. All right, so that is it. Whenever the seller is the subsidiary, we treat it in the net asset schedule. Whenever the parent is the seller, we treat it in the group retained earnings. So just get that in before we continue. The second one, on June 1, 20x7, can do transferred an item of plant to shelter for $15,000. Its carrying amount at the date was $10,000 and its remaining useful life was 5 years. Alright, this is the transfer of non-current assets, and in this case it is the parent who is transferring the item to the subsidiary. Get me very carefully. Even though the parent is the one who transferred the item of plant to the subsidiary, shelter is going to hold this plant and is going to depreciate it, and the depreciation is going to be an excess depreciation, which is going to reduce the retained earnings of the subsidiary shelter. So what we are going to do is that we are going to adjust for that excess depreciation in this net asset schedule. That is what we do. Alright, now note 3, can do values the non-controlling interest using the fair value method. Okay, at the date of acquisition, the fair value of the 40% non-controlling interest was $50,000. This one, there is no hassle. As I said in my previous video, whenever the value is not given to you directly, as we have here, what you do is that you take the number of shares that is allocated to the non-controlling interest, and then you multiply that by the share price of each of the shares of the subsidiary at the date of acquisition. But here they have been given to us directly, so no hassle. Let's continue. An impairment loss of 1,000 is to be charged against goodwill at the year end. Now we are measuring non-controlling interest at fair value, so the treatment of impairment loss, I hope you can guess that. Alright, shelter earned a profit of 9,000 in the year ended 30th November 20x7. Okay, noted. So we continue. The loan note in shelter's books represents monies borrowed from can do on 30th November 20x7. Okay, so when we go to the separate financial statements, the non-current liabilities, we see a 20,000 here, and they are telling us in the notes that it was borrowed from the parent. And so this 20,000 is included in the investments amount here, because the parents, the subsidiary has borrowed, but in the books of the parent it is an investment because you're going to receive interest at the end of the period. Right, but this transaction occurred at the year end, hence no interest to be earned. Now the last note here, which is the note 6, says included in Kandu's receivables is 4,000 related to inventory sold to shelter during the year. Shelter raised a check for 2,500 and sent it to Kandu on 29th November 20x7. Kandu did not receive this check until 4th December 20x7. That's good. So this is an example of a current balance situation, and this is an example of a cash in transit. So we were going to look at it and then we'll see how we are going to do it. So from there we know that our share capital at the date of acquisition remains 40,000 because nothing has been said about it. So our post-acquisition profits is going to be, or the post-acquisition movement in our share capital is going to be 0. Alright. right? How do we calculate the post-acquisition profit? It is the value at the reporting date less the value at the acquisition date to get our post-acquisition reserve. Now, what is the retained earnings of the subsidiary or of shelter at the date of acquisition? So what we are doing is that we are going to subtract the amount that we have earned after acquiring the subsidiary at the reporting date. We are going to subtract that amount that we have earned to be able to get the amount at the acquisition date. So this is what I mean. We will have our 69,000, and then the amount of profit we've earned was 9,000 multiplied by 7 months over 12. So I'll enter, and that gives me 63,000. Now what did I just do here? I can calculate my post-acquisition profit as the 9,000 multiplied by 7 over 12, which will give me 5,250. Or I can just go ahead and subtract the amount at acquisition from the amount at reporting to get that. So let me just copy the formula down. This is 5250. Let me copy the formula down and see what it will give me. It gives me the same amount, 5250, as you can see from the formula bar here. All right, so that is it. So this is how we calculate our. You have to be very careful when you are dealing with this retained earnings, either at reporting date or at the acquisition date. All right, so that is it. Now from our notes, from the notes 1, we know that there's going to be a PUP, that is provision for unrealized profits, on the goods that have been held at the reporting date. How much has been held? It's going to be 8,000 multiplied. So this is a markup on the value of the goods, which is the sales. So we are going to have 8,000, and then 25% into margin. We'll have 25 over 125. 25 over 125. So quickly I will come here. So it's not going to affect our acquisition date retained earnings. It's just going to affect our reporting date as well as the post acquisition profits. Why? Because the sale happened after we acquired the subsidiary. So we have equals 8,000 times 25 on 125. So we have 1,600 here, and this is an adjustment on our profit. This is an excess profit, so I can put it as a minus there. Right, so this is a minus, and then for our acquisition date, it's not going to affect it, but it will affect our reporting date as well. So I'll come here and then I'll copy the formula down. So this is supposed to be 0. So we have that. Now we have negative. So we have that. Okay. Then the next thing, as we saw in the second note, is the transfer of the item of plant. So what is the plant? The plant has been transferred for 15,000. Its carrying amount at the date was 10,000, and its remaining useful life was 5,000. So what we are saying is that this plant might have been depreciated by shelter. So provision for unrealized profits. Now when it comes to the provision for unrealized profits on our non-current assets, so let me have non-current assets. What happens is that we use a nice schedule to do it. So let me quickly come down here and do a nice working 6 here, and I'll name it PUP on NCA. And then what we do is that we assume the non-current assets as transferred. So we'll have it with transfer here, and then without transfer amount. I'm going to explain this in a moment. So we have transfer and then without transfer, and then the difference becomes the provision for unrealized profits. So what you are saying is that when it comes to the issue of the transfer of non-current assets, whenever there's a transfer of non-current assets, we prepare this small working here, and it is to help us ascertain the seller would have recorded in the books and how much it has actually transferred the asset subsidiary or to the entity within the group, and then we find the difference between the profit elements. So let's take it and see. So we'll have the carrying amounts. Let's look at the carrying amounts. As I said, I wouldn't be going back and forth. You are following the question, so let's continue. The carrying amount here, when it is happening with the transfer, let's go to the notes. It says that on 1st June 20x1, the second note is saying that on 1st June 20x1, Kandu transferred an item of plants to shelter for 15,000. That is the with transfer amount. So when the transfer happened, we transferred the amount. But when it did not happen, the carrying amount was 10,000, which means there is a profit element of 5,000. That is what we are talking about. So we come back here with the transfer amount. It was transferred at 15,000. When the carrying amount without the transfer is 10,000, right? So our provision for unrealized profits is the difference between with the transfer amount and then without the transfer amount, 5,000. I hope you get it. So that is what we have. And then we are going to depreciation. We are going to calculate depreciation on the amount transfer amounts. And this depreciation is the asset is being depreciated over its useful life of 5 years. So to get my 5 years, we are calculating just 1 year's depreciation. So it's going to be 1 over 5 years. Multiplying it by this amount, the cost of the assets is going to give us that amount. Then we are going to multiply this by the post-acquisition period, or the period within which the asset was transferred. So the transfer was made on 1st June. So we are going to count the number of months to 30th November. So we are going to have 1st June. So we are going to have June, July, August, September, October, November. So that's 6 months. So we are going to multiply whatever we get with 6 months, which is 6 over 12. Right, so we have that. I'm doing this for those who are writing. So I'll have my equals, this amount multiplied by 1 over 5 multiplied by 6 over 12. I'll close my parentheses. Close my parentheses here and hit enter. And then I can copy this amount to using Control R, so that my post-acquisition profit becomes 500. But this is not supposed to be so. It is an excess depreciation. It is an excess depreciation. So I'm going to do this as a negative. Okay, so I can't actually do that here. So it's supposed to be a minus figure, so that at the reporting date, we will have this amount here. This is going to be equal to the 15,000 minus depreciation amount. This will be equal to the 10,000 minus the depreciation amount. and then the difference is going to be equal to this minus this, and that will give me 4,500. So this is what we have here. So what we are saying is that these these are the PUPs that are going to have this excess depreciation. The depreciation element was being calculated by the subsidiary because they bought the assets. They were holding the assets, so they were buying, or they were calculating the depreciation elements. So this depreciation element is called an excess depreciation, or the provision for unrealized profits. We are calling it in this situation. It's an excess depreciation which should be added back to the retained earnings of the subsidiary. So quickly we will come here, and then I'll put here working 6. So this is actually W6. Alright, W6, and then at the reporting date we are going to add the excess depreciation back to the profit of the subsidiary, and then it's also going to be added to my post-acquisition profit as well, because it has happened within the post-acquisition period. So when it happens, item happens within the post-acquisition period, we treat it under the reporting date as well as the post-acquisition profit, or the post-acquisition movement, or the post-acquisition reserve column. Alright, so this place is going to be dashed as well. Let me put this here, the middle. Right, good. So we have everything set up for us. So from the additional information, we don't have any other information that will affect the retained earnings of the subsidiary. So we are done. So we can actually come and calculate everything here. So I have alt equals, add everything together here, and then I can copy my formula across. So we have this nicely. Let me put some borders here, top and bottom, and then bolding it. Alright, that's good. Now let's go to workings 3, goodwill on acquisition. Now I've done extensively with goodwill, so we should fast track with the goodwill calculation here. So the first one is going to be the cost of investment, or others will say the consideration transferred, fair value of consideration transferred. Whatever term you see, this is the same thing, cost of investment or the fair value of consideration transferred, is all referring to the same thing. Okay, so our cost of investment, we have, let's go to our information here. Is this here? So can do bought 60%, paying 6,000, 76,000 cash. So it is on cash, and that is the only form of consideration we have. We might have other forms of consideration, but in this case it is only one. So that is 76,000 here. Alright, then we will have the fair value of the NCI at acquisition. We will add fair value of NCI at acquisition, and that has been given to us directly. As we can see here, can do values the non-controlling interest using the fair value method. At the date of acquisition, the fair value of the 40% non-controlling interest was 50,000. So quickly I'll have my 50,000 here. Then I can add those two together. So alt equals adds it for me. Let me put my border here. Okay, then the next one is to less my fair value FV of the identifiable net assets. So let me just shorten it, NE at acquisition. And that is going to be equal to, what's the fair value of the identifiable net asset at acquisition? That is the value we have, 103,750. So I'll refer to this figure right here, and then I'll press OK. So that is the value we are having there, and then the difference between the total value of the business as a whole, which is the 126,000, minus the fair value of the identifiable net asset at acquisition, will give us our goodwill at the acquisition date. So that is going to be 126,000 minus the fair value of the identifiable net assets, and that gives me goodwill at acquisition date. Then we were told goodwill has been charged with an impairment loss of 1,000. As I said in my previous video, goodwill is not amortized. Rather, it is tested for impairment. That is a subsequent measurement of goodwill. We test it for impairment, and then we less any impairment from the goodwill. So we have less impairment, and that is 1,000. So I will have equals this minus this, and that gives me 21,000. So that gives me goodwill at the reporting date. So this gives me my goodwill at the reporting date. Let me do that nicely. Alright, so we have that one also sorted out for us. Now we go to the workings 4, which is the non-controlling interest, also known as the NCI. With the NCI, we have the fair value of NCI at acquisition, and that is equal to this particular amount that we have here, fair value of the NCI at acquisition, 50,000, and then we'll add the NCI's share of the post acquisition. So let me shorten this to make life easy. And that is going to be the 40% of the NCI percentage. So you have the 40% of the NCI percentage multiplied by the post-acquisition profits, which can be found in workings 2, 4150. So I'll have my 4150. This is for those who are writing. Alright, so we have 4150, and so I'm going to put it here, 40%, which is 0.4 times 4150. So that gives me my share of the post-acquisition profit. And since we are measuring the NCI at its fair value method, we are going to apportion, as I said in my previous video, we are going to apportion the impairments between NCI and the group retained earnings. So we'll have NCI percent of impairment loss, and that is also going to be 40% multiplied by our impairment loss, which is 1,000. So this is going to be 400. So having that, we can calculate our NCI. We will have 50,000 added to the post-acquisition profit share, and then we will subtract the impairment loss, and that gives me 52,260. All right, that is my impairment, my non-controlling interest. Then our fifth major calculation is the group retained earnings. Our group retained earnings. When it comes to the group retained earnings, we first pick 100% of the parents' retained earnings, and that can be found in the separate financial statements. So we come here, and then we have the group retained earnings of the parents, 189,000, and then we will have the parents' percentage of, so this is parents' percentage of the post acquisition profit, and that is going to be 60% times the amount, which is 4150. So 4150. I have done these in my previous videos, that's why I'm rushing with these ones. So this is equal to 0.6 times 5150, and that gives me 2490. And then also we'll have the parents' percent of the impairment loss, and that is going to be 60% times 1000, which is the impairment loss. So that is going to give me straight away 600. All right, and then remember that the parent transferred a plant to the subsidiary, and that transfer was made at a profit, which we calculated within the PUP calculation that we had here. So that place, let me cut this and bring it up a bit here. All right, so we have our parents transferring the NCA at a profit of 5,000. So that 5,000 is going to be subtracted from this particular profit of the parent as well, of the group. Okay, so we'll have PUP on NCA. All right, PUP on NCA, and that was found in workings 6. So always put your workings here to show that that is where the figure is coming from. So that is 5,000. So we can now calculate our total retained earnings, and that is going to be equal to the 100% of the parents added to the parents' share of the post-acquisition profit less the impairment loss less our provision on non-current assets transfer, and that gives me 185,890. So those are our workings for us. So quickly, let's go and finish up the building of our consolidated financial statements. So for the non-current assets, as I said, whatever I'm going to put in these columns, if you are writing manually, please put them inside the brackets that I've created here. I don't want to make this video too long, so please bear with me. So for the parents, the PPE, it is going to be, they are going to take the parents figure, which is 138,000, and then the subsidiaries, which is 115,000, and then we are going to adjust it for the net provision on the provision of unrealized profits on the non-current assets that we have here, this particular amount here, we're going to adjust it for this amount. So we have that. So I'm going to have the group amount being the addition of these two, and then I'm going to subtract the PUP adjustment amount. Okay, so that will give me my non-current assets, that is the PP. Then the investments is going to be the total amount, which is 98,000. I am going to subtract, we don't have any investment for the subsidiary, so what I'm going to do is that I'm going to subtract the amount of investments in the subsidiary, which is 76,000, and then the loan amount, which is the 20,000, which I said is an investment the parent has made in the subsidiary. To the subsidiary is a loan, but to the parent is an investment. All right, so we're going to adjust it for that. So the net investment is going to be 98,000 minus the amount you used to buy the subsidiary minus the loan amount, and that will give me 2,000. All right, then our goodwill calculation can be found in workings 5, in workings 3. So quickly I'm going to scroll down and locate my goodwill figure here and adjust it for that, and then I can find the total. Alt equals, add that together, and then when it comes to my inventory or the current assets, I have my inventories here. For my inventory, it's going to be the parent figure 15,000 plus the subsidiaries figure 17,000, and then we are going to adjust it for the provision for unrealized profits element, which we found in workings 2. Will be 600. All right, so because this amount is negative, let me just make it a positive figure, 1,600, so that I know that this is the addition of this plus this minus the 1,600. So that is the inventory amount we are going to, the profit on the inventory we transferred, that we are lessing from the total inventory figure, because it's an intra-group transaction. Now our receivables is going to be 19,000 for the parent, 20,000 for the subsidiary, and then from note 6, here, we've been told that Kandu's receivables is 4,000 related to inventory sold to Shelter during the year. Shelter raised a check for 2,500 and sent it to. So if this is a receivable and we are paying 2,000 out of that amount, we are going to adjust it here. All right, so we are going to have, these are receivables that the parent is expecting from the subsidiary. Now the subsidiary has transferred 2,500 to the parent. All right, so we are going to acknowledge that receipt, and the treatment is that we will treat it as if it has been received, so it has reduced our receivables figure. So this amount here is actually going to be subtracted from the addition of these two amounts. All right, so we are treating it as though it has been received, and this same amount is going to be added to our cash. That is the treatment as though it has been received. All right, then now there is a net amount. The amount we were owing, the amount of goods that has been transferred is 4,000. So there is still left with 1,500 to be eliminated. That is the difference between the 4,000 here and the 2,500 check transfer. So there is still an element of intra-group transaction there, which is 1,500, which is left to be transferred. So I'm going to add it to this particular figure. So that is going to be plus 1,500. So in effect, that is 4,000 here. All right. So now when you are writing it, when you are writing manually, you can come here and write 19,000. Let's make life easy for you. 19,000 plus 20,000 minus 2,500, which is, we can put a little bracket here, cash in transit, CIT, and then minus 1,500, and then you can put brackets here, and intra group, just something to show something, okay, so that you can close the main bracket and then you can hit enter. So that is it. So I'll come here and then I'll have my 19,000 plus my 20,000 minus my 4,000, which is 35,000 for my receivables. Then for the cash, as I said, is going to be for the parent. Cash for the parent, that's 2,000, 0 for the subsidiary. So we have 2,000 for the parent, 0 for the subsidiary, and then we have received a check which is in transit, so 2,000 of 2,500. So I'm going to have this. We are treating the check as though it has been received by the parent. So we have 2,000 added to the 5,000 here, and then we have 4,500. So I can add this figure together. So to make the presentation nicer, I'm going to create a copy of this. So I'm going to copy this, come here, and then I'm going to paste it special as values. So I'll come here and paste it so that it doesn't copy the formulas I have already used. So let me expand this to get my figures there, and then I can delete these to make the presentation nicer. Alright, now to differentiate it from the other ones, I can select the whole of this and make it bold. Okay, so we know that this is what we are working on. So what is the total? The total is going to be equal to the sum of these up to here. Enter. And then I know that my total assets is going to be equal to this plus this, and that will give me 341. Let me quickly double underline that. All right, put a border at the top here. All right, then we have, that is it for our assets. Now we go to the equity and liabilities. For the share capital, is going to be the share capital of the parent only, as I said in my previous video, of the parent only, and then also the retained earnings, which we have calculated in workings 5. So I'll go there and pick my retained earnings figure here. Controlling my non-controlling interest, it is our workings 4. So I'll go and pick my non-controlling interest figure here, and then I can add those 3 together using alt equals. And then my non-current liabilities, the 8% loan, has been eliminated because it has been confirmed. Note 4, which we saw here as the loan note in Shelter's books, represent monies borrowed, and that was the reason why we subtracted it from our investments to get our net investment that is outside of the group. So this has been confirmed, the loan note has been confirmed to be an intra-group transaction coming from one entity, in this case the subsidiary, to the parent. We have to eliminate it. So actually this particular non-current asset should be taken out from the books. So I can delete it. Taken out from the books, and then we'll have our current liabilities figure for the parents. So let me come here and freeze the panes. So I can come here, and freeze the panes so that I know under what column I am working on. To freeze the panes, I can go to view and then freeze panes, and then freeze panes, so that when I'm scrolling up I can still be seeing the parent sub adjustments and all that. Alright, that's just a bonus trick, Excel trick, for you to help you navigate the Excel window. So we have our parent figure here, and that is 33,000. For the sub is 23,000. Then we'll adjust for the intra-group trading, which is the 1,500 which has been left. So out of the 4,000, the parent has transferred 2,000 to the parents. So it's left with just 1,000 in the books diary as payable. So we're going to eliminate that from the books. Alright, so we'll have this plus this minus the intra-group transaction, and that is going to give me this. So I can add these two together, and that will give me the total. As you can see, it has perfectly balanced. So this is how we prepare our consolidated financial statements. As I said, if you are writing, please, instead of putting these figures in, you put it in the brackets, and then you forget about all these columns, the three columns here, and then you have your two separate sections for your group figures. Alright, so thank you very much for your time. This has been a very comprehensive video. I hope you have learned what it takes for you to prepare the consolidated statement of financial position, because in my next video I'm going to continue to the consolidated statement of profit or loss and other comprehensive income, and then after that we will look at associates, that is investment in associate and joint ventures, IAS 28. So thank you very much for your time. I hope you can now be confident when it comes to the preparation of consolidated financial statements. If you have any questions, leave them in the comment section and I'll be ready to attend to them. And then also consider liking the video, share with your friends so they can also benefit from what the Gen Z analyst has been sharing here on YouTube. Thank you, and I'll see you in the next video.